$11.75 billion. Seriously, just let that number sink in for a second. That right there is the massive enterprise value of the largest outbound acquisition in the history of Indian pharma. Welcome to The Explainer, folks. Today we're going to unpack the sheer audacity and really the precise financial mechanics behind this absolutely historic deal.
I'll be your host, and today we're putting on our financial analyst hats to break down Sun Pharma's transformative leap into global dominance. We'll be looking closely at the buy-side thesis of their agreement to acquire Organon. We want to analyze exactly how this transaction reshapes their global market positioning, and of course, the very real risks involved.
Okay, let's dive into this. Here's our roadmap for today. First up, the $11.75 billion mega deal itself. Then, unlocking women's health and biosimilars. Third, we'll look at valuations, synergies, and global scale. After that, the $8.6 billion debt burden. And finally, integration risks and headwinds.
All right, Section 1, the $11.75 billion mega deal, changing the global pharma landscape.
So, on April 26, 2026, India's largest drug maker, Sun Pharma, dropped a bombshell. They announced a definitive agreement to acquire New Jersey-based Organon, which, you might remember, is a global healthcare company spun out of Merck back in 2021. The premium being paid here is just fascinating. Sun is offering $14 per share in an all-cash deal. That is a massive 103% premium over Organon's unaffected closing price earlier in April. This offer values the equity at roughly $3.99 billion. And when you fold in Organon's existing net debt, well, that's exactly how you arrive at that colossal $11.75 billion enterprise value we talked about.
And this brilliantly illustrates the transformational scale of this deal. Just look at the stark contrast here. Before this deal, Sun Pharma was a net cash positive company pulling in roughly $6.2 billion in annual revenue. Post-acquisition, the pro forma combined entity is going to pull in exactly double that, $12.4 billion. But, and this is a big but, it comes at a cost. It leverages the company up to a 2.3 times net debt to EBITDA ratio. It's a fundamental shift in their capital structure to buy unprecedented scale.
Moving on to Section 2, unlocking women's health and biosimilars, buying market share.
To really understand why Sun is willing to leverage its pristine balance sheet, you have to look at what they're actually acquiring. They're buying instant global scale in highly lucrative, specialized areas. Organon's flagship division is women's health, boasting major heavy hitters like NuvaRing and Nexplanon, which happens to be the world's most widely used contraceptive implant. This single acquisition catapults Sun Pharma into a top 3 global position in women's health virtually overnight. I mean, we're talking about a high-margin category with incredibly strong brand loyalty and recurring revenues. Building this kind of footprint organically would have taken them a decade, easy.
So the crucial point to take away here is that they aren't just buying current revenue. They are buying a future growth engine. By snagging Organon's biosimilars portfolio, which features products like Renflexis, Hadlima, which targets the massive market for the world's best-selling drug Humira, and Ontruzant, Sun immediately bypasses years of really expensive R&D. They achieve top 10 global scale in one of the entire industry's fastest-growing segments. It's a total game changer.
Okay, Section 3, valuations, synergies, and global scale, the deal math.
The strategic fit is crystal clear, but hey, as financial analysts, we have to ask the hard question. Is Sun Pharma actually paying a fair price for this massive expansion? 6.2x. That is the enterprise value to EBITDA valuation multiple Sun is paying here, based on Organon's $1.9 billion adjusted EBITDA. And you know what? In the pharma world, this is considered quite reasonable. Similar-sized listed entities in the U.S. specialty segment typically trade at 7 to 8 times EV to EBIT. So from a pure valuation standpoint, the entry price actually shows a lot of discipline. The pro forma combined entity profile is the payoff for that 6.2x multiple. We already talked about the $12.4 billion in revenue, which pushes Sun straight into the top 25 global pharmaceutical companies. But it's the geographic and product mix shifts that are truly staggering. They'll now have a presence in 150 countries, with 18 large markets generating over $100 million each. Plus, innovative medicines jump to 27% of their total revenue. This effectively transitions Sun from a generics heavyweight into a fully diversified, global innovative player. Now, to make the deal truly accretive, Sun has outlined some very specific synergy targets. They're projecting over $350 million in cost savings over the next 2 to 4 years. But honestly, the revenue synergies are even more exciting. Sun can now push its existing pipeline right through Organon's massive commercial infrastructure. Crucially, Organon provides the hidden optionality of establishing a real footprint in China, a market where Sun has historically struggled to gain traction, along with huge manufacturing optimization across 6 sites in the EU and emerging markets.
Let's turn to Section 4, the $8.6 billion debt burden, the cost of expansion.
In financial analysis, we always have to use the yes, but technique. Yes, the scale is fantastic, but we absolutely have to look closely at Organon's revenue mix. While we've just been praising women's health and biosimilars, a concerning 55% of Organon's revenue actually comes from its established brands segment. This is essentially a portfolio of off-patent legacy products that are on a natural decline. So if this legacy segment declines faster than the new segments can grow, managing that massive new $8.6 billion debt load to protect long-term earnings, that becomes significantly riskier.
So how exactly is Sun Pharma structuring this mountain of debt? Well, they're exploring several sophisticated financial engineering tools with global lenders. We're talking about seeking consent for bond swaps with existing Organon bondholders, potentially issuing euro-denominated bonds to secure a better credit rating, and raising $3 to $4 billion in offshore loans. The ultimate goal here is to aggressively manage down Organon's debt, which currently carries an interest rate of around 5.5%.
And that brings us to Section 5, Integration Risks and Deal Headwinds, Stress Testing the Thesis.
Buying a company is one thing, right? Successfully integrating it is an entirely different beast. We have to warn you about a potential near-term overhang here. Analysts project that the combined entity's growth rate could actually fall to the mid-single digits. That's a noticeable drop from Sun Pharma's historical standalone growth rate of 10 to 12%. Because of the sheer scale and complexity of this integration, meaningful synergy gains really aren't fully expected to materialize on the bottom line until 2028 or even 2029.
Plus, there are some immediate red flags and execution risks that require flawless execution. Listen to this. Organon's Q1 2026 results showed 19% and 46% demand drops for key products, Nexplanon and Singulair, respectively. Ouch. Add to that the intensified competition in the biosimilar space, the absolute monumental task of culturally integrating a U.S.-listed company across 140 countries, and the guarantee of intense antitrust reviews in multiple jurisdictions. I cannot stress this enough. Flawless execution is absolutely mandatory here.
Yet, despite all these headwinds, Sun Pharma's leadership is leaning right in. There's this incredibly telling quote from Chairman Dilip Shanghvi. He said, "Although the company is debt-averse, it is not risk-averse. This opportunity generally would be difficult to get if all the times are normal." This brilliantly illustrates their whole strategy. It's a calculated gamble. They are seizing a rare, transformative asset precisely because global market conditions are currently turbulent. They see an opening, and they're taking it.
Which leaves us with this final, provocative question to think about. Is this a decade-defining global leap for Indian pharma? Or is it an $8.6 billion debt trap? Sun Pharma is consciously trading short-term leverage and massive integration headaches for instant global scale, top-tier assets in women's health, and biosimilar dominance. Will their legendary execution track record hold up under the sheer weight of this megadeal? Well, that is exactly what financial markets will be watching incredibly closely over the next 24 to 36 months. Thank you so much for joining me on this explainer, and keep your eyes on those integration milestones.